Where are you?
We're in a bit of a different setting today because we are at a conference. So apologies for the strange background here, but hopefully we'll make up for it in terms of content. How do you think the conference went today? Did you enjoy yourself so far?
Yeah, very much. It was we're at the EPP, European Pricing Platform Conference in Amsterdam, and we already had a session together on a what was it called? Pricing in the digital age. Very different topic, but I think that already went well, and now we'll add one on top, I hope.
Perfect. Yeah, we have a double decker of content today, so good to be here today. And if you want to start sharing your presentation as people are just joining in here, I will explain a little bit what we're going to be talking about, and also a little bit the how we usually do these webinars here. So welcome everyone to the Pricing and Revenue Management Methods webinar by Binomics. I'm your host, Paul Hanke, and I'm joined by Ingo Reinhardt today, who will be leading this insightful session. We'll expect to analyze a little bit the current established pricing methods. We'll analyze them one by one, kind of what are their strengths, their weaknesses, where do they come from, why do we have them, and what are also maybe some of the things that we can change about them. And maybe if we go to the next slide, we can quickly introduce ourselves. So Ingo Reinhardt, our host today, has over 12 years experience in pricing and revenue management. He's developed the Binomics method, which he will showcase also in today's session a little bit. And I'm Paul Hanke. I'm head of sales at Binomics, and I'm leading also the insights team. And I'm here to moderate today's session. So if you have any questions, feel free to ask them in the Q&A below. You can see that on Zoom. In the toolbar below, you can see the Q&A. And I'll write something in the chat as well if you want to kind of have more of an open Q&A forum. And that's also quite nice to see a bit of a discussion going on. So feel free to chime in with questions, and I will basically answer them or have Ingo answer them at the end of the session. So Binomics is a cloud software for revenue management decisions. We have 4 things that we think make us special. Number 1 is our comprehensive approach to the topic, really starting from first principles, and Ingo will explain that in the session. We're also quite accurate, which we're proud of. You'll see that we also can generate insights quite quickly, and in the end, this makes for more profitable decisions. I think we brought a case study that showcases this as well today. So this is Binomics, and with no further ado, I'll hand over to you, Ingo. I think if you go to the next slide, then we'll start the discussion on pricing methods today.
Perfect. Thanks, Paul, for the intro. And yeah, also welcome from my side to everyone. I hope we brought something interesting now Friday afternoon if you're in Europe, Friday morning if you're in the UK, closest to the weekend. So let's discuss some important topics within our field of pricing. And before we go into the pricing method, I think it makes sense to just put a little bit of background before we discuss the pricing method. I think we're living at the moment in interesting times with lots of like macro things going on that also affect what we do within pricing, revenue management, and related topics. I think the key points we're faced with is certainly the persistent inflation that has been high for quite some time. Maybe it's peaking at the moment, but there's still a lot of uncertainty in terms of pricing, also in terms of inflation. Also, I think a big effect is the fear of a recession that might affect different countries differently. with obviously direct implications for pricing. If demand goes down, if people have less money to spend on certain categories, this is something certainly that that we need to deal with in our pricing and revenue management fields. Also, I think putting a challenge on the field are regulatory challenges or regulatory changes, something like carbon tax that add cost to certain products that need to be considered, and other limitations. For example, the HFSS regulation that puts limitations on what can be done with products with high fat, sugar, or salt. And this affects, for example, how certain promotions can be used, how products can be packaged, and these changes, regulatory changes, can have a high impact on the portfolios of companies. And of course, it's important to understand how they affect the portfolio, how forced changes by regulation affect the portfolio, and what to do with that. So if you decrease the size of a product, what does it mean? What does it mean not only for demand, but also for price, and how this product relates to other products in the portfolio. Technological changes are, of course, often typically important. So I think there are different areas where technological change is important. One is that affects each industry individually. If there's progress in the products you sell, you have new features that didn't exist the year before, there you need to understand how to price them. And there's, of course, also technological change in how we can understand the world we're living in, and technologies that become available to pricing or revenue managers. This is, for example, something that we at Binomics are working in. So we're adding to the available set of technologies for pricing and revenue managers. Also, I think this is important, particularly for pricing, is the last point, capital market requirements. As we're seeing in capital markets, particularly with the decline in the value of many technology companies, is that capital markets are currently also, with increasing interest rates, moving a bit from favoring growth over profitability. So in the past years, we saw many companies that weren't profitable but growing fast, and they were favored by stock markets. And now we see a shift more towards companies that are already profitable. And this, of course, has very, very direct implications for pricing, as pricing is a lot about the trade-off between profit, growth, revenue, and we actually hold in our hands the steering wheel to fine-tune that trade-off. So these are things that, of course, not only affect pricing and revenue management, but they certainly affect us. And the question is how to deal best with it. And typically, and this is the topic of today's webinar, we have certain data, objectives, levers, tools in our hand, and of course also certain pricing methods, which is the focus of today's session. And in the end, what we produce are typically something what we show here in the middle of the graph. We define an offer, for example, a good, better, best offer, different sizes of products. For example, the famous wine bottle example, you have a good wine, a better wine, and the best wine at different prices. And the question is how to best price these products, how to best set up your offer. Should you actually have 3 products, or would it be better to have 4 products or just 2? These are the typical questions that we're dealing with within the field of pricing and revenue management. Just to conclude, I think, always I ask this question, if anyone thinks we're missing something important from the game here, then please write into the chat. We're happy to add everything we've missed, but I think we're fairly confident that we have an overview on the important parts that play a role. And just to put this picture together here, so typically on a strategic level, always have the question of what are the proper objectives, what profit, revenue, maybe also market share goals do we need to reach, which, if you remember on the previous slide, the capital market requirements certainly comes to a very strong degree from there, that defines what role pricing plays in the overall game. And we have certain levers to achieve these goals. We can work, for example, with our list prices. We can work with our portfolio architecture. We can work with the trade terms. When we work through retailers, for example, we can work with promotions, certainly very present at the moment with Black Friday coming up. And this game is of course important. Promotions, for example, if you have everyone knows you have a promotion next week, then many wait with their purchase, and you see that the weeks before and also the weeks after. So this is a complex game overall, and the tools that are available are certainly, from what I've seen, they're still probably more Excel than most people expect and want. And there are certain other management tools in hand. There's particularly in larger organization also some pricing management or price setting software at play. But our focus today will be more on the methods that are used within that field. And also this differs certainly between industries. There are different data sources available. Some industries have transparency on their own and their competitor sales, for example, if they sell through retailers, and many other industries often use also surveys, conjoint, other pricing studies, Van Westendorp, and so on. And in many cases where data is lacking, we still see a lot of expert judgment to make the call. So, but today's focus is pricing methods, and we put together here the 5 routes or the 5 methods that we see most frequently. And again, if you think we're missing something, then please add it in the chat. We're happy to discuss and also add it afterwards. So if we go from left to right, I think the starting point of pricing, and probably when someone has a new product and focus on the product and then adds pricing at some point, cost plus is one of the first choices in many cases. So the idea is you have your costs of 100, you add 50 as your margin, and then your prices are 150. And essentially you don't watch too much on, you don't pay too much attention on what the demand is, but you only add a certain percentage on the cost basis. You see that in many traditional industries, for example, many restaurants, they work in a way that when they price a meal, they take just essentially the cost of making the meal, multiply it by 4, and that's the price, roughly the price they will aim for. Of course, if you just do that, everyone knows that you ignore many things. You ignore your competition, you ignore the customer, and only look at yourself, what's from your point of view a fair price. To compensate that, I think the second major factor is the competitive pricing, and the idea is essentially that you look for your competitor prices and add a markup or markdown, and you say, okay, there's a market price of 100 in my industry, and I'm a little bit better than the average, so I can charge 105 or 110, or maybe I'm a little bit below my competition. There are other market leaders with a stronger brand, so I can't charge 100. I have to go with 90, for example, and you just follow your competition. And that's something that's actually reasonable, I would say, for smaller companies in markets with very strong competitors who set the market price, and you have little resources to do your own market research and don't have a complete pricing or revenue management team, but you only follow your competition. That's certainly something that makes sense, particularly for a smaller organization. More technical in the approach is typically what we understand as elasticity or price elasticity based pricing. And the idea is to understand how demand and prices are connected. And typically, even in more advanced, maybe machine learning concepts, these analyses to determine the price elasticity are typically regression based. So you want to understand typically a linear or an exponential relationship between the price and the sales. So the idea is to understand, if I increase my price 10%, how much sales do I lose? Maybe 20%. And if that's the case, then we have a price elasticity of -2. This takes account just by itself, of course, of demand. And and we'll look into that a little bit deeper on the following slide. It considers demand, but it to some extent ignores competition, right? Because once you have computed this number, price elasticity -2, you can't capture what your competitors do. So if you do pure price elasticity pricing, do your analysis, and what you take to the next stage is just the number, the -2, then you're ignoring your cost and you're ignoring the competition. A different way of looking at customers is typically the value-based pricing. And the idea here is, and it's often done in a connection with price differentiation or product differentiation, that you have a product. Here in our case, you have a ski jacket, and you have different versions of it. So you have a synthetic version, you have down filling, you have different levels. So you have a waterproof and a non-waterproof version. And the idea is that the down filling has more value to the customer, in this case about $50. So the down jacket is $50 more expensive. And if you then add waterproof, you can add, I think it's another 50. So, and this gives you the price differentiation. So this is typically an approach that is most used in cases where you have a large portfolio, where you have to price dozens or hundreds of thousands of products that are linked in some way with each other. And you want to have a structured pricing for your products. And one is where you essentially have control over your pricing. So if you have a logic like this, it's really easy to understand where this price comes from. So you have this product here, it's synthetic, waterproof, 150. It's easy to understand why did we price it at 150. It was because we didn't add anything here and we added 50 euros here. So it's really easy to understand. But what it doesn't really do is it's not an optimization approach typically. It provides a logic, a structure, but in setting this, you don't have, you have the idea that you ask, for example, via a survey that customers are willing to pay 50 euros more for this or dollars. But that doesn't mean that having this product $50 more expensive than the other one is actually the profit optimal price. It might be that, for example, if you lower the price a bit, you draw more customers that would buy this year otherwise up, and this is more profitable. So this is not really, it's not really an optimization method. And then the last one that we typically see in the pricing field is the broad area of behavioral pricing. And it's about, I would say, a wide range of ideas or principles that relate to the fact that real humans don't act in a fully rational way. So for example, I think one of the most prominent one are price thresholds. So if you have a product that's costs around €1, and if you sell it for €1 versus 90 cents or 95 or 99 cents, you typically lose, I don't know, somewhere in the area of 20-30% in sales, just because it crosses the price threshold of €1. So this is something that we typically don't find rational. So in particular, it doesn't fully match with the price elasticity logic here. So where you draw typically like a linear equation through it or something exponential, you don't have these thresholds in these curves, and it's also difficult to estimate quantitatively if you have like a broken linear regression or something like that to consider for the price threshold effect. So again, we see we have a concept here that is related to price elasticity and value pricing, in the sense that it looks at the customer, but it's not fully compatible with the other two, because it's based on a different set of assumptions essentially. And in practice, and this also goes back to before founding Binomics, I worked about 9 years in consulting, pricing consulting. This is typically something that I've seen a lot in the field, is that to consider all of these ideas, we see a method like this, where the different concepts are applied in sequence. It doesn't always have to be the same sequence, but it's often something like that, where you start, and this also works for small portfolios, but more often for large portfolios. For example, if you're a retailer and you need to price a large category, if you sell something like spare parts, where you have thousands of different parts across different vehicles, and you want to maintain some logic that in the end, when you see a price 17.95, that you understand why you put 17.95 and not 16.14, for example. So just to go through quickly, is here you have your cost. You say, okay, I need to have some base margin to cover my costs. That gives you something like a base price, and then you have these value attributes. You have the more, let's say you say that blue products are 5% more valued than red products, and then you add these value drivers here on top under 2. Then you do typically something like a competitor check where there are direct competitor prices. You see that you're not too far off your competition, and also check with a price elasticity approach, are you in the right, are you close to the profit optimum considering price elasticities? And then in the end, you do something like price cosmetics. So if this logic here with markups and markdown produces something like 20 euro 17, you would probably go to 19.99 so that you consider the price threshold. And of steps, there are different things that can be added. But typically, to get all of these things together, a concept like this is applied. And if you have anything interesting or you have seen some similar things or very different things, happy to discuss this at the end of the webinar. But I think this is typically how these different methods are put together. And this would be typically something that's called rule-based pricing. So it has elements essentially only through the price elasticity of an optimization. All the other steps, how you compare to competition, should we be 5% above or below, that's typically not optimized in this area. And this brings us to another idea. Here is that of machine learning, because many in the field of machine learning claim that they do proper optimization. And I think from what I've seen, there are 2 things that are being added from machine learning. One is here on the left side, demand estimation. And this is typically, I would say, a more elaborate form of this price elasticity up here, that products typically are, or the idea is to understand the price elasticity or more generally the price sensitivity. And the idea is it typically works in 2 steps. One is if you have a large portfolio, you aggregate products that are similar in their price sensitivity, where you think for different reasons they have a similar price range or they have a similar customer segment, that they address similar customer segments. They are somewhat similar. So you identify products with a similar price sensitivity. And then within these segments, you run something, as I said before, like a regression analysis to understand the price elasticity in these fields. And then with these results in the second steps, such methods go to optimization. And from our experience, this first one, understanding demand, and this is one way. I'll show you another way on the next slide. Understand how demand reacts to price and offer changes. And then the second part, the optimization part, is typically much simpler in most cases. For example, in the simplest case, if you only have one product, then it's really easy, and you know the elasticity and your costs, it's really easy to find the profit optimum, because in the profit optimum, you always have margin times elasticity is -1. If you have a portfolio of cases, it's obviously not that simple, but a good way is to, for example, with help of a computer, you can iterate through a large number of cases to find the best one. So in essence, the optimization part is typically much easier than the first part, understanding how demand works, how customers react to price or other offer changes. Just to conclude on the price elasticity, there are many things wrong with it, and I think looking at the watch, we won't be able to go into all of the details of that. But typically, a statement like this product has this price elasticity, or this product is more elastic than the other one, is highly problematic, because price elasticity changes with price. For example, if you have a linear demand function, what you see is that it usually takes all the values between 0, price elasticity of 0, the price of 0, and a price elasticity of minus infinity if you go to the maximum price where people buy. So a product takes all the prices, all the price elasticities between 0 and minus infinity. So it doesn't really make sense to say a product has a certain price elasticity. And also in reality, and this is based on a real case that we saw, is that price elasticity, of course, is not linear, but can take all kinds of shapes in this case. And this matters a lot. Let's take a very quick look at a reasonable case that I think most of us are dealing with at the moment, and that is the case of how to pass on a cost increase, which is of course particularly relevant at the moment with high inflation. So the idea is that your own costs increase, and the challenge to you is how to pass on this price increase. And we saw the equation before. In the optimum, you have margin times elasticity is -1, so that's fairly simple. But even in the case, if you compare a linear demand function and an exponential one, price elasticity is the one where you have a constant price elasticity. It's curved like this. You have very different suggestion on what's the right reaction to the cost increase. So under linear demand, what you do is you pass on half of the absolute cost increase. So for example, you have a product, you have costs of 100, and you sell at 200. You have an elasticity of -1, so that's your optimum, and your costs increase from 100 to 110. You pass on half the cost increase, so your new profit optimal price is 205. If you have an exponential demand function like this here, what you need to do is because you have the same elasticity, so you always have to have the same margin. So you pass on the percentage change in cost. So the costs go from 100 to 110, and your price should go from 200 to 220. So it's the same price elasticity. Everything's the same. The only difference is the how this function here is curved. And these are the two, I would say, standard examples that are typically used to highlight how price elasticity works. And their implication, you have a cost increase of 10 euros, and the suggested optimal reaction ranges from 5 to 20. So that's a huge implication or huge range, which really highlights the point how difficult it is to work with these price elasticities. All right. I think for the last 3 minutes, sorry that at the beginning it took a bit longer. I just want to talk about how we think it's done properly, and this is essentially the concept that we have developed, the virtual shoppers or virtual customers, and the idea is that we create a very large set of personas, essentially, not 3 or 4, but tens of thousands, hundreds of thousands, depending on the context. And each one of them has a specific set of preferences for products, for brands, for product sizes, everything that's relevant for a decision. And they can also have, some of them react to price thresholds, others don't react to price thresholds. Some react to, for example, if you have an online offer, you highlight one of the products, they tend to buy this if you recommend to buy product 2. Others don't. So just like real people. And these are typically always parameterized from, for example, sales data, survey data, expert judgment, the data sources we saw in the beginning. And so if you change something in a method like this, each one of these virtual customers makes an individual decision. So the pink ones here buy product 1, the blue ones product 2, the gray ones don't buy anything. And if you change the price in a product, you see that more and more don't buy this product anymore if you increase. And this produces the demand function for an individual product. And if you have the demand function, it's really easy to also get the revenue and profit functions right. And with a method like this, and I'll jump to it just very quickly to highlight the essence. Just give me a second. See the essence. So we have here Then I'll hand back to Paul. A very simplified portfolio. You sell 4 products, peanuts in different sizes, 1,000 grams, 750, 500, 250. You have competitor products in the category. You have defined everything that's relevant. You can define if the product is in promotion. You can also say where it's located in the store, what brand it has, what the trade terms are, what the costs are. Everything is set up as it is in reality. And then you essentially show this offer to the virtual shoppers. If you, for example, increase the price, you lose sales. So we increase this by 20 cents, you lose 170 units in this week. Some of those go into your own products. Some go to a competitor. In this case, only few will not buy anything anymore because we increase the price. And a system like this solves many of the challenges that we have seen before. So it addresses the inflation case we had. It addresses the regulatory challenge that we have. If, for example, you're not allowed to sell 1,000 grams anymore, you see what happens if you just take out this product or replace it with a different size. It solves the profit versus revenue challenge that we have. And it also integrates very naturally the cost, the competitor, and the customer and the behavioral views that we mentioned before in the different methods. And for example, and I'll conclude with that, if we have a real challenge, in this case, we have a cost increase, let's say of 20% in our portfolio. So this is the portfolio I just showed you. And now we have an increase in our, you have an increase in the costs. So here all the costs have increased 20%. If you don't change prices, of course, units stay the same. Revenue stays the same, but profit declines significantly in this case. And the question is how to react to that. So you can increase all of your prices by 20%. You see that it's a little bit more profitable. If you're alternatively thinking, what happens if I downsize my products by 20%? So I go from 250 to 200, from 500 to 400, keep all the prices the same. What would happen? This is what happens. And in this case, it's less profitable. It also produces less revenue. So if you choose between the two, it's better to increase prices in this case than it is to downsize. And of course, you can also look at all of the variations in between. And that's for that. I just wanted to give a brief intro how we think these different concepts can be integrated. And with that, I'll hand over to Paul.
Yeah, thanks, Ingo. Super interesting talk here. We went from kind of the basics to the future, and also saw a hands-on example, which I think was really appreciated. We talked to some guys today at the conference, and they say they really like if we have like an actionable example. So that's why we try to put that into these webinars. Feel free to give us additional feedback, be it in the chat or by email. We're always happy to do that. I saw some questions here in the chat, which are great indicators that people are liking today's webinar. They're asking whether we can share the slides and whether the webinar will be available on a link afterwards. And both, yes. So everyone who registered for the webinar, whether they attended or not, will be sent a recording of this webinar, and also the presentation of this webinar. So check your inboxes around Monday, Tuesday, and we will send it out to you. You can also visit our website. I just posted it in the chat. We actually had a revamp on the website with a new design, so that those of us who know us from before, happy to get some feedback on how you guys liked the new redesign. I think it's we got some positive resonance on that so far. I think that's it in terms of questions, Ingo. They mainly were more interested in finding out how they can revisit this, and also
should we be concerned about this?
Sorry?
Should we be concerned?
No, I think they're positive. The comments are quite positive. Very valuable content, super interesting, great content. So I think that's a good indicator. If you skip to the next slide, then we can just kind of look at what we have on the calendar for the rest of this year. So we have our pricing strategy for 2023 webinar, and that will be taking place early December. So stay tuned for that. And
we have the Christmas special, right? Before.
Is that before? Okay.
It should be before Christmas. No, it should be later in December, right? Oh.
Exactly. So that will be mid-December. Ingo already is anticipating that's Christmas webinar, so stay tuned for that as well. I saw someone wanted to ask a question in the Q&A, but it got cut off. So feel free to send it now, or otherwise we're happy to answer this by email. So I'll just give a few more minutes unless anyone has. So Melissa is asking where we can find the recordings of the previous webinars. They're all on the website. So just go to binomics.com and you can see that in our resources section. So there you'll find both the webinar recordings, all the white papers and stuff like that. So a very good question. And then the question came through on the Q&A from Marcos. He's asking, isn't the elasticity the P in a linear demand? So he's, I think, asking a bit about the formula for price elasticity. So can you just maybe pull that apart really quickly, Ingo?
Yeah. So in a linear regression, the price elasticity is not the slope, right? It's it changes with price. So it goes from 0 to minus infinity. And I think if you see the formula, we have it in the full formula on the slide. And then you see the elasticity is not the slope, because it's always scaled with the different price.
Yeah, so that I think was a super interesting slide as well. So if you think about the demand function, it actually has a different elasticity at each point of the price unit chart. So if you want to know more about that, if you have more technical questions, feel free to reach out. We are available under info@binomics.com, and always happy to have a chat about pricing, revenue management, etc. And then Marcus is also asking how we train our virtual shoppers. So I'm assuming maybe we can give a quick intro on how we get from data to the model.
Yeah. So we won't be able to cover that fully in the remaining minutes, but there are different data sources, and each data, so like sales data, transaction data, survey data, expert judgment, and each one of these has a different way of integration. And the really fascinating thing about the method is that you can very naturally integrate these different insights. So essentially all of them, historical data, surveys, and so on, I think how they're properly understood is as measurements of customer preferences. So you have a group of people and you want to understand how they value certain products. One way of doing that is observing what they actually buy at different prices in different promotions. Another way is to ask them how they value these, or how they value different products. Of course, with their advantages and disadvantages in each one of these methods. Do the people tell what they really mean, or do they say something else? But essentially, these are all measurements of customer preferences. For example, with sales data, this is where we apply different machine learning algorithms to essentially fit the customer preferences to the observed data. So the question is, the algorithm answers how are preferences distributed among these shoppers, such that they buy what we observe in each week. And if we do that for longer periods of time, maybe 3 years, where we have about 150 weeks, then we have 150 periods with different sales and different products. And they are all produced by the same preferences of these virtual shoppers. There are some trends, of course, over time, but essentially this is what the algorithm does: is reads out the preferences of the virtual shoppers, of the real shoppers, to create the virtual shoppers. And with this, there are different algorithms for each data set. If you're interested, we're happy to discuss in more detail, but we won't be able to cover this fully in the next minute.
Yeah. So yeah, if you want to know more, if you think your company in the space of consumer goods, software, telecoms could use a software like Benomics, also feel free to book a demo on our website, and we're always happy to give you an introduction of how we do these things and how our method actually works in practice. So visit benomics.com to learn more there. And if you're not already following us on LinkedIn, do that as well. You'll be updated on our latest content, webinars, etc. As well, so that you're always in touch there. I think that's it for today, Ingo.
Yep.
We have the rest of the conference to attend, so I'll get us back to having those conversations as well. Thanks everyone for the comments today, and yeah, look out for your inbox on Monday, Tuesday for those recordings and the presentation itself. So have a great weekend, and we'll see you soon.
Thanks. Have a great weekend. Bye.